Hi traders, welcome back to another YouTube video. So in this YouTube video, I'm going to specifically talk about market structure. So what is market structure? How do you identify which direction the market is in? How do you know when the market has been reversed or if the condition has been shifted? So when it comes to market structure, there are three main points that I'll go through in this video that I want all of you, whoever's watching this video, if you want to learn something new, make sure you write down all these 3 points. All right. So the first one is what I call the higher and lower time frame. So market structure is not just about if support is being broken, it becomes a resistance. If resistance is broken, it becomes support. It all depends on the way you read, the way price reacts, the way price move on both the higher and lower time frame. Because if the higher time frame is in an uptrend, it doesn't necessarily mean that the lower time frame must be in an uptrend as well. The lower time frame can be in a downtrend. So I'll give you one example here. If I simply draw a box here, let's say right here, I put it in the replay mode, and if you look at the 4-hour time frame, you clearly know that this is a bearish trend, right? Very obvious. Everything is pointing downwards. The market is in a downtrend condition. But this similar pace of price action, if we drop down to the 3-minute chart, what trend are we in? Assuming if we are looking at this piece of price action, we are in a uptrend. All right. So this is basically the first point that I'm trying to highlight, which means if you are looking to identify the market structure, the first thing first is identifying which kind of trader you are. Are you a long-term swing trader? Are you a day trader who trades the 15-minute chart? Or are you a scalper who scalps a 1 to 3 minute time frame? Market structure is very dependent on which time frame that you want to focus. If you are someone who scalped the 1 minute time frame, then honestly you don't even have to look at the 4-hour chart. But why do I always talk about multiple time frame analysis? Is basically because it allows you to lean towards the bigger forces, which means your probability of success and your risk reward is highly magnified. You are leveraging the function of high time frame to improve your accuracy, your entry, and your risk reward. All right. So first point, remember, market structure differs based on the higher and lower time frame. So do not just look at the 4-hour chart and say, hey, market is in the downtrend on the 4-hour time frame, therefore I should be looking to sell. It doesn't make sense for someone who are trading the 1-minute chart. If you are trading the 1-minute chart, this could easily be a good green day for you, a good strong bullish day for you, because your perspective are very different from someone who are trading the higher time frame. So that's our first point. So what is our second point? So that's our first point. The second point is basically your support and resistance zone or level. So support and resistance comes in 2 ways. We all know that it comes in dynamic and it comes in static. Static means horizontal support and resistance, something like this, a zone or a level, up to you. Then dynamic means is a trend line, is a moving average, whatsoever. So support and resistance helps you to guide your short-term market structure. So assuming right now, if you are looking at here, anything before this vertical line are still basically in a downtrend, right? We have lower highs, lower lows formed. We have price respecting previous structure. We have a continuation. But what gets interesting is the way price starts to accept low at 1809.13. this is where we have a potential structure shift. But even up until this point, you cannot identify whether if it's really a true bullish reversal or if it's just some sort of pullback leading to further continuation. Yeah, so the only way you can really confirm it is to wait for price to start showing more strength and potentially starts running higher and higher and higher, forming higher price, higher acceptance, things like this. When price does this, it basically concludes that we no longer accept new lows. There are a lot more buyers, everyone accepting high bids, therefore we are willing to buy at a premium. Especially the big players, they are now stepping in at a high price because potentially they feel like it cannot go anywhere cheaper. That's why people are now starting to be willing to pay for a premium, paying for a premium, and this is where the retail traders start jumping in, following the big boys direction. Right? So this is an example of the horizontal, or what we call static support and resistance. So what is a dynamic support and resistance? So I'll just give you one example. I'm not trying here to drag the video way too long. Second example is basically trend line. So trend line, I would say trend line is really a very common thing being used by retail trader. From the big boys perspective, from the institutional perspective, I don't think so. I don't think the hedge fund will rely on trend line with billions of capital. It is simply not so trustworthy. I believe trend line is just a pattern, an angle, where if the angle is being broken, it suggests that we are potentially looking at some direction shift. We have some short-term structure shift. It doesn't mean anything, because one big problem that I notice that's always being made by retail trader is every time when price break above the trend line, they start going long, which means retail traders are often being stuck in a situation like this, where they are getting in way too early, where they buy or sell into every trend line break, which leads to further continuation into the initial direction. So assuming trend line break works differently, so I'll give you two examples. Here we have two trend line. Let me know which one do you think is a lot more reliable. So the first condition is we have a trend line bounce like this, then price starts chugging up. This is our first situation. Second point is where we have a trend line, then we does this. Which one do you think is a lot more promising? 1 or 2? I'll give you 5 seconds. So the answer is definitely number 2, because when price breaks above structure like this, it clearly tells you that we have a lot more demand than supply, especially people who are smashing the buy here are big. It simply tells you that people who bought it here have a strong intention to push price higher because they find value there. Therefore, they smash the buy button, and it really pumps up the price a lot higher. And this one, do you think that is really a trendline break? It is similar to the condition happening here. This is not a trendline break, because trendline isn't supposed to be there as well. Trendline is being drawn by us, especially from the retail trader perspective. We like to use a lot of different lines as a framework to identify the trend. You need to understand that even when the market is bouncing off the trend line, it doesn't necessarily mean that it has to bounce off the trend line forever. It doesn't have to respect the trend line. In fact, this is just a line. Remember, trend line is just a line. It can be removed easily using the delete button. It can be removed. And if you find that the trend line is being too distractive, just remove it. Because if condition like this happen, it basically tells you that the market is just in another pullback, which leads to further continuation. Yeah, this is exactly where a lot of retail traders are getting stuck at. They are relying way too much on this kind of lines or indicator, which leads them to making wrong decision. It's not because they are bad at trading, but purely because they do not look at price from the price section perspective. from the chart perspective, but rather they're looking at the chart with a line perspective. Make sense? So don't rely way too much on this kind of trend line whatsoever. But horizontal support and resistance are pretty much very reliable. Why? Because everyone look at them the same way. I'll give you one example. Trend line is a very, very subjective tool. Everyone draws a trend line differently. So again, I'll repeat this. We are currently at the second point, support and resistance. We talk about horizontal one. Now we talk about trend line, right? Dynamic SNR. Trader A can draw a trend line like this. Trader B can draw a trend line like this. Trader C can draw a trend line like this. So which one is correct? The answer is no. There's no definite answer to that. And that's the reason why trend lines sometimes are not so reliable, because every trader look at trend line very, very subjectively. And if something is being too subjective, it doesn't offer enough liquidity. It doesn't offer enough momentum to shift the direction of a market. Makes sense? But horizontal support and resistance are pretty much identical. Everyone will look at this and say this is a resistance. Obvious, right? Obvious. Everyone will look at this and say this is another resistance. Everyone will look at this and say this is our lower lows. This is our all-time low. Yeah, that's why I say relying on horizontal SNR or static SNR is a lot better than trend line, because those things are basically not so identical. Everyone look at them the same way. It's very subjective. But again, SNR works in different time frame as well. If the SNR on the higher time frame may be very different on the lower time frame, so just be aware of that. So that sums our second point, and here goes our last point. The last point is market condition. So market condition pretty much contributes a big part in whether if you are able to identify real market structure or not. Because one mistake that I see retail trader makes very often is, let's say we look at, I'll give you one example right here. They look at here, especially for those who are trading the 5-minute chart, 3-minute chart, 2-minute chart, lower time frame. They might look at this and say, oh, here we have a resistance broken, therefore I should buy. Right after they get into the market, market starts reversing. And then when market starts reversing, they look at this as a support being broken. And in fact, they start selling short right here, just to see the market again stops them out. So what I'm trying to highlight here is market structure differs according to market condition. Before you start identifying the direction of the market, the first question to ask yourself is, what is the current market condition? If the market condition is range bound, which means the market is moving sideways, we are respecting highs, respecting lows, bouncing between a range, then you should basically just trade the range. Don't jump down to the lower time frame without studying the high time frame, and then you start smashing the buy and sell buttons. Because if you do not know what's happening on the high time frame, high chance you will be misinformed, and you will get stuck in situation where you take the buy, you get stopped out, take the sell, get stopped out, and then the cycle repeats, and it leads you into a deep drawdown because you do not know what's the market condition. Market structure only works well when the market is presenting a trending condition. If the market is not in a trending condition, so trending condition is basically means the market is in a healthy uptrend, a downtrend or an uptrend. Because when the market is in a trending mode, it's easy to make money because you simply sell at resistance, buy support with a nice stop loss placement, of course. Alright, so market condition, remember, play a big role. Market doesn't just have an uptrend or downtrend. It has a potential range bound condition as well. So just be aware of that. So that sums up our video today. I'll just quickly give you a summary. The first point, we talk about higher and lower time frame. Basically, it means that the market structure on a high time frame could be very different from what you are viewing from a lower time frame perspective. So do not fall into the trap where you are a day trader and then you start looking at daily chart, you see that the market is in a downtrend, and then you only fix your bias onto the short side. So in that way, you are actually limiting your potential. And then second point, you are limiting your opportunity. Third point, you are not really respecting your strategy, because as a day trader, you shouldn't really be trusting 100% on the high time frame. Right? That's mainly for a swing trader or for someone who's trading the 1 hour chart or the 4 hour time frame. So second point, support and resistance. Support and resistance works in two ways. First one is static. Static means we have horizontal support and resistance. Then we have dynamic SNR, which is trend line, moving average, VWAP, whatsoever. Third point is basically market condition. Do not trade something, or do not trying to identify the direction of a market, or trying to sell resistance, buy support without understanding the condition. Because if the market condition is presenting range bound, you should sell resistance, buy support, and rise and repeat the process again and again and again until the range is being broken. Alright, so I hope you learned something new. If you like the video, please don't forget to like, share, and subscribe, and I hope to see you in the next video. Take care.